I've spent a lot of the last 20 years of my career working with private equity and small businesses. And if there's one way to build generational, transformational wealth, it's through the sale of your business. But positioning your business for sale is not as easy as just throwing up a for sale sign. Today we're going to cover 6 ways that you can use to drive maximum value into your business. Most entrepreneurs who end up surviving that first couple of years have amazing and highly profitable businesses, but that doesn't mean that those businesses are actually saleable or have much value to anyone other than the entrepreneur running it. Business valuation is based upon what a business is worth to somebody else, not what it's worth to you as the entrepreneur. And so transferability of operations and the assets, intellectual property, and the sustainability of that business over time are key drivers to business value. As you work hard to build your business, ensure that you're building a business in a way that really permits you to maximize the value and sell it at the end when the time is right so that you can go pursue your next dream. If you currently have an unsellable or undervalued business, or thinking about starting a business, or at an inflection point in your business where you're getting ready to position it for the next stage, there may be things that you can do to position yourself better. We're going to give you today 6 strategies to maximize business valuation. The first one is probably the most important. Ensure that your skills, your personal skills, aren't the only value in your business. If you're the only income stream, you're drastically limiting your ability to sell your business. This may mean hiring others to provide some value, and it may be that your short-term profits go down for long-term business viability. For example, if you're a YouTuber, you can build a business around YouTube, but as soon as you come off the channel, that channel no longer has any value. So it's very difficult to sell that channel to someone else. However, if you've got a business around that channel that doesn't rely on you, and you've got some other personalities on the channel as well that you can begin to fold in over time as you're looking to exit, you may find that you've got not only a transferable business there that has significant value, but that those other personalities are likely your exit point to transition that business to someone else. Number 2, over time, you need to attempt to remove yourself from the income producing activities. If you're the head salesperson, or if you were the key attorney, you need to be able to get to the point where you've removed yourself from those things in order to sell the business, or at least gotten to the point where you could be removed from those things. Many business buyers are looking to purchase a company that allows them to create a full-time job for themselves. However, a lot of other buyers are looking to be just investors. They're looking for a business that can be run from afar, can be run absentee, with minimal time demands, and can run itself. Making $1 million a year with 60 hours of work isn't bad at all. It's a really good way to make a living. Accomplishing the same with 30 hours a week of work because you've got a business built around that concept is way better and a heck of a lot more valuable when you go to sell. So, keeping the other items in mind, how can you effectively reduce your workload to 30, 25, 20 hours a week as you progress and maintain some level of reasonable business profitability? Imagine if you could only work 20 hours a week. What changes would you make to your business in order to allow that to proceed? What about 10 hours a week? Could you restructure it and still be profitable? If you could do those things, it makes your business far more sellable because you've opened it up not only to an entrepreneur who wants to run the business, basically buy a job, but you've also opened it up to potential investors who are looking for a great return on their money but aren't necessarily interested in operating that business day to day. Number 3, project possible income. Potential buyers are interested in the amount of income they can expect to earn in the future. You've already earned and taken out a significant amount of income in the past. You've invested in the business. You've built a lot of things. You may have some intellectual property. You may have some proprietary software. You may have some elements to your business that are going to be difficult to replicate. But if those elements to your business don't generate future income, if you've spent a lot of money to build something that nobody wants, it doesn't have any value. So depending on the type of business you have, the business will sell for a multiple of expected future earnings. And the exact factor is going, or the exact multiple is going to vary business to business. Those businesses that are highly replicatable and highly scalable tend to sell at multiples that may be 5 to 10x earnings. Those that are consultant types or rely heavily on people to run them and don't scale well, maybe 2 to 3 times earnings. So keep in mind that anything that can be done to boost the productivity and the profitability of that business is going to be returned to you not only with bottom line profits in your pocket, but also 2, 3, 4, up to 10 times at the point at which you sell. So keeping your expenses low and projecting how that profitable income stream goes into the future is going to be key to maximizing the value of that business. Number 4, consider your risk and the risk of the buyer. Buyers want to know how much risk is involved in earning the income. Is a business in a field with a lot of growing competitors that are going to squeeze that business out? So you're an early mover, you may have a segment of the market, but are you seeing a bunch of increased competition that's going to put pressure on margins or put pressure on market share? How long have you had those lucrative clients or customers on board, and are they sticky, or are they can they easily move to a different customer base? Do you have a significant amount of debt that the business is carrying that's going to need to get paid off on sale, or that's going to need to be assumed by the buyer? And if so, what does that look like when it comes down to the purchase price? Do you have a large working capital requirement? Meaning, do you have a lot of physical inventory that you need to maintain, so there's a lot of cash tied up in that inventory, because that's going to impact the purchase price as well. Businesses that require very little working capital are a lot more attractive to an investor than one that requires millions and millions and millions of dollars to maintain inventory, and that inventory might be slow to turn over time. The other component to keep in mind is if you have 1 or 2 major concentrations of income source. So you're on YouTube and that's your sole income source, or you're on Amazon FBA and that's your sole income source. Amazon could change their terms and you're out of business tomorrow. Google could change their terms if you're reliant upon a blog where it's all AdSense revenue, and they change their terms tomorrow. Facebook could change their terms tomorrow, and all of a sudden you're out of business. And so that's concentration risk. You may have 1 or 2 key clients, and if you lost one or more of those key clients, you might go out of business. So you might have a great client. You've got the insurance account for Walmart. You're making money hand over fist, but if Walmart changes agents and you're not that sticky and you sell the business, that business doesn't have a lot of value. So concentration risk is a really important one as well. Make sure that your income sources are diversified, your platform is diversified, and as much as possible you control your outcomes. Number 5, assess the business's potential. What are the long-term prospects for your company? Is it a business that can grow into the future? Is there a limit, a logical limit, either in terms of population, geography, or financial capability that really caps the business out? The more potential your business has, the more you can get for your company when it comes time to sell it. And then number 6, seek expert advice. Business brokers are generally willing to give advice for a small fee. Sometimes they'll do it for free if they think that they're going to get the listing. And some business brokers operate similar to residential real estate brokers, where they're going to take a segment of the sale and they'll do it essentially on speculation that the business is going to sell, and other business brokers require a fee or a retainer to be able to sell your business. And business brokers are generally for your smaller businesses, and then you use an investment banker to sell larger businesses. A business broker stands to make a fair bit of money if you decide to utilize them to sell the business. Commissions on a business sale can be upwards of 10 to 12%. So it could be a very lucrative for the business broker to maintain a relationship with you. Take advantage of that situation by pumping them for information, getting a feel for the market, and getting their input on what can make your business more saleable. Find a business broker with experience in your type of business so that they know that industry vertical, they know the potential buyers, and they've sold some of those businesses before, so they've seen the due diligence done, and they understand where you're going to run into some challenges, what buyers tend to look for, and how best to position that business or address those before you put the business up for sale. A couple $1,000 spent at the beginning of the process to get some of that consulting and expert advice is going to be potentially worth hundreds of thousands of dollars on the sale of that business. And so if you can find someone that really fits the bill for that expert advice, go ahead and engage them. And the earlier you engage them in a process, the better off you're going to be, because it's a lot easier to change a business early in its life cycle than it is when you're just getting ready to sell. With some planning and a little bit of advice, your what might feel like unsellable business today can really be worth a lot of money, positioned right and structured right. Get the expert advice you need, structure the business, put the value producing activities in a position where you don't need to be the one driving that value, reduce your concentration risk, and when it comes time to retire or to sell the business and go to the next thing, you'll be glad you did. It'll give you a significant amount of wealth. It could be generational in nature, it could transform your life, and it could certainly set you up to drive to FI.